The purpose of this video is to provide an overview of the retirement bucket approach. I believe this to be a foundational aspect of a well-designed comprehensive retirement plan, because the bucket approach for retirement, it's a combination of two major things. It's a withdrawal strategy as well as an asset allocation strategy or approach. Those are two critically important areas where retirees oftentimes struggle, especially as they initially transition into retirement. And the bucket approach is a strategy which aims to meet those concerns. In summary, the bucket approach, it's a framework in which you divide your portfolio into three time-based segments or buckets based on when you anticipate needing to spend the money. You're essentially aligning your time horizon with an allocation to each bucket. Each bucket has a unique and distinct time horizon, a unique purpose, and therefore different investment allocations for each of the three buckets. So let's spend a little time walking through each of the three different buckets. As you can see on this matrix down the left, as I mentioned previously, each bucket has its own unique time frame, objective, and investments that are appropriate for the bucket. The first bucket is the income bucket. This is the money that you're going to need now. It's essentially your paycheck for the first period of time, oftentimes 1 to 2 years worth of time. So because it is your paycheck, it's paramount that you have stability and safety of the principal as objective number one. So you don't want this money exposed to the ups and downs of the market. The investments that are appropriate for this bucket are obviously cash and cash equivalents, your checking accounts, savings accounts, money market accounts, and so forth. The second bucket, beyond that, that's for periods oftentimes 3 through 10 on this framework. Now, and compared to the first bucket, you do want a little bit more growth. You want interest on this money beyond what you're getting out of your checkings account or savings accounts or CDs. So you do need some growth, but again, your objective here is to have stability and safety of the money too as well. So oftentimes bonds are the most appropriate investments for this second bucket, the safety bucket. And again, depending on how much money you have allocated into this bucket, you often get into, you may be layering in dividend or growth in income oriented equities into this bucket too as well for the later years. And then finally, the third bucket is the growth bucket. So this is the money that you're not going to need until 10 plus years out of retirement. So the purpose of this money is obviously growth and appreciation. You want this money to grow to outpace inflation over time throughout your retirement. So this is going to be where the majority of your equities are going to be allocated within this third bucket. Now, the bucket planning process has many benefits in addition to being an effective way to position your assets for a secure retirement. The first benefit is that it's easy to understand. The bucket approach is relatively simple and straightforward, making it easy to understand, like I mentioned, and it makes intuitive sense. Thereby, it's an excellent strategy for retirees to get comfortable with, and most importantly, something they can commit to, especially given market volatility that you'll experience throughout your retirement. The second major benefit is it's built on three that I listed here, core investment principles: time horizon, diversification, and risk tolerance. A well-designed bucket strategy is built using all three of those principles in its foundation. The third benefit is again, as I mentioned, it's diversified in a time-segmented portfolio. So the bucket approach aligns your time horizon with your investment approach, which helps you get comfortable maintaining a well-diversified long-term portfolio with a focus on total return, not just on producing income from the portfolio. Another benefit is it mitigates several of the major retirement risk factors that you'll face throughout your retirement. So those include market risk, sequence of return risk, and inflation risk. The two first ones there, market risk and sequence of return risk, those are the key risks that folks leading up to retirement and transitioning into retirement are going to face. And basically what that means is that, or the risks that you're exposed to, is a significant downturn in the market right before or as you transition into retirement. So again, having the money segmented into different buckets mitigates those risks. And then the third risk that it does a great job of mitigating too as well is inflation risk. And this comes through using bucket 3 with the growth orientation, again, with its sole purpose being growth and appreciation to outpace inflation over time. Another major benefit of the bucket approach is it helps avoid many of the major and costly mistakes that often get made. So within the bucket approach or the bucket plan, each bucket has its own purpose that helps you avoid making decisions, oftentimes emotional decisions, that could negatively hurt your long-term plan. Knowing that you have money for near-term spending needs and it's secure in cash within bucket 1 and bucket 2 helps retirees oftentimes cope with the fluctuations that will inevitably accompany the stocks and bonds portion of the portfolio. This structure prevents a lot of the panic and emotional decision making that often occurs during times of market volatility in retirement. And then finally, the last major benefit is the bucket approach is very customizable and flexible in how you implement it. The allocations to each bucket, as well as the investments within each bucket, can easily be tailored to your personal comfort level for both volatility and risk, ultimately providing you with the security, stability, and confidence to enjoy your retirement. As I just mentioned, one of the benefits of the bucket approach is that it's very flexible and can easily be customized to your specific needs. How you actually divide your money amongst the buckets and which specific investments you use within each of the 3 different buckets can be very flexible and often depends on the following factors. The first one obviously being how much money you have, what's the size of your investment portfolio. Another one being how much income you'll need to live on and when you need it, and for how many years you'll need to live on that income. Another big factor is what rate of return and rate of inflation that you're expecting or predicting. And then another one is your level of risk capacity and risk tolerance, with your risk capacity being how much risk you're financially able to accept based on your personal financial conditions and situation, and your risk tolerance being how much risk you're actually willing to accept. Each of these factors may trigger you to change, either increase or decrease the allocations and the timeframes associated with each bucket. For example, if you have a sizable portfolio and are very risk averse, you may want to lengthen or extend the amount of money that you have to bucket 1. So instead of just maybe a year or 2 years, you may want to have 3 years worth of cash built up. Or you may want to extend, or additionally, you may want to extend the amount of time that you're accounting for bucket 2 as well. And again, if your financial condition doesn't permit, or if you have higher risk tolerance, again, you could go the other way, maybe shorten bucket 1 to just be a year and a half or something like that. In bucket 2, instead of being years 3 through 10, maybe it's 3 through 7, with bucket 3 maybe increasing in size based on that. So again, it's very flexible, very customizable based on your personal situation and your risk tolerance and such. Again, the purpose of this video is just to provide an overview of the retirement bucket approach. And in summary, the bucket approach is a framework in which you divide your portfolio into 3 different time-based segments or buckets based on when you anticipate needing to spend the money. The bucket approach it's a simple framework to structuring your assets to provide reliable income when you need it, as well as, very importantly, to grow your money to outpace inflation throughout your retirement. By segmenting your money into the 3 different buckets based on your investment time horizon and your specific personal risk tolerance and income needs, you can mitigate, or if not eliminate, certain risks and avoid making bad decisions, oftentimes emotional decisions, that could cause you to run out of money in retirement. We hope this video was very informative, and certainly reach out to us if we can help in any way, and how this bucket approach may help you in your retirement. Thank you very much for watching.